The world's greatest value investors continue to stress the importance of emotional control in the investment process. But while everyone knows what needs to be done, very few are capable of actually doing it. One such investor on the local scene is RCM, who have demonstrated the ability to be patient during periods of underperformance. Linda Eads joins us in studio to discuss the RCM Global Flexible Fund. But before we go there, some context from Warren.
Thanks, Bronwyn. We just wanted to get to something that I picked up this week. It was an article written by Jason Zweig in the Wall Street Journal, talking about how many people claim to be value investors but struggle with some of the periods of underperformance that follows. And he actually quotes a very famous investment manager by the name of Jean-Marie Evelard, a Frenchman who went over to the States and started running the SocGen International Fund. That's since been renamed. And just to give you some context as to how well he's done over an extended period of time. If we go to the next table, we'll actually see when he was running this fund for a period of 25 years, from the beginning of 1979 till December 2004. His track record in the fund was an annual return of 15.8%, and that was against the MSCI World Index 11.3%. What's interesting as well is that over the entire period the fund's been running, it's delivered almost 4.5% alpha in relation to the MSCI World Index. So the value investing process is one that's very effective. But we get to this point around the pain, and if we just go to the next slide, which is a quote that Jason Zweig used in this article, he says here, most people aren't cut out for value investing because human nature shrinks from pain. And just to put that into context, some work done by Summit Street Capital Management in New York, they've just done an analysis of value investors, and they found that as much as up to 1/3 to 40% of the time, value investors underperform. So you've got to have the strength of your convictions during those periods of underperformance before you get the returns. And RECM follow a very similar value philosophy. So my first question to Linda tonight is, how do they steel themselves for the periods of underperformance that will most certainly precede the fantastic performance that we've seen from their funds?
Thanks, Warren. Yes, well, I think the most important thing is that you've got to attract investors who understand your investment philosophy, where obviously the value philosophy has resonated with them. And as a result, they understand that there may be periods in the short term where you perhaps lag the market or your peers, but ultimately over the long term, you're going to deliver the right returns. And for us as professionals, it's really about the conviction that we have in our investment ideas that gives us the fortitude to sit it out.
How do you manage to cope with the pressure that comes from the asset management community as a whole, with the ratings, with the awards, where there is, Linda, let's be realistic, a focus on short-term performance?
Well, absolutely. I mean, in the short term, you are going to get periods of time where everybody thinks you are investing in the wrong assets, that you've just sort of lost the plot somewhat. I think what makes it a lot easier is when you have a track record to demonstrate previous periods in history where you've gone through the exact same thing and then have proven to be correct in your thesis. That certainly makes it a lot easier to withstand the short-term external pressure.
Linda, I just wanted to get to this point that he made, obviously investing over that period that I mentioned in the intro. He's gone through the dot-com bubble and then the crash that followed. And he said that, in the first year, his investors were a little bit upset. The second year, they were furious. And the third year, they had left him. And I think he mentioned that 2/3 of the fund had been liquidated over that period. Have you guys been through any situation like that where you found it so tough and investors, despite being educated about your process, have still elected to leave the fund, and you've had to sit with periods of redemptions and withdrawals that you've had to kind of see through before the performances come back?
Yes, well, as I say, when you've got a track record, it's easier, when you've been through a full market cycle. But obviously, the first time you go through that period of time, usually in a late stage bull market where assets are getting expensive and you're basically refusing to participate in that momentum in the market, so you tend to lag your peers in the market. We certainly had that in 2007, prior to the financial crisis in 2008, where everybody was buying into resources. It was the commodity super cycle story. And we essentially had no Anglo-American in our fund. We had very little resources in our fund. And as a result, we were lagging substantially relative to the rest of the market. Obviously, when the financial crisis came about and the likes of an Anglo-American fell by 75%, and we held none of that in our portfolios, and as a result, our portfolios really held their ground, the investors that stayed with us were really strengthened in their relationship to go through it another time. Obviously, during that period, we did lose some investors since it was the first time we were going through that, but now looking back, we have the track record to show that the process does work over full market cycles.
Right now, Linda, value managers as a whole are underperforming, given where equity markets are. That's a fair comment.
Well, certainly on the local side of things, that is a fair comment, where essentially it's the defensives and the retailers and the like, which are continuing on their momentum drive, and the resources and the sort of cyclical stocks are out of favor. And you tend to find the value investors are investing in resources because they're cheap, whereas the market has really been driven by sort of the expensive assets. So locally, that's very much the case. Within a fund that we're going to talk about later on in the program, the Global Flexible Fund, luckily we have the opportunity to invest locally and globally. And globally, we've had some very good value opportunities which have come to fruition. And those at the time that we sort of started talking about them didn't seem like a very good idea, but have proven sort of their worth in terms of the value philosophy.
Linda, just to get into that, and we did want to talk about the portfolio holdings of the RECM Global Flexible Fund, and let's turn our attention to that now. I just wanted to get some discussion around, you've got Amplats and Anglo American that have moved into the top 10 in quite a big way in the fund. How do you distinguish generally between a company that offers excellent value and a possible value trap?
Well, at inception, in terms of the investment idea, you really don't know what is going to be a good value idea over the long term, which is actually going to bear fruit, versus a value trap where that particular stock remains cheap indefinitely or becomes even cheaper. I think one of the key things that we focus on as a business in terms of identifying opportunities is, first and foremost, we prefer high quality businesses. So what do I mean by that? I mean businesses which have very strong barriers to entry, which show that their track record of delivering returns over and above their cost of capital is likely to continue into the future. The great thing about high quality businesses is that they tend to grow their value over time. So, for instance, if you've made an incorrect assessment of the fair value, and worst case scenario, you've actually bought above the fair value, those businesses will grow into that value over time. Now, that obviously is not an ideal scenario, but there you're not losing capital. And first and foremost, as value investors, is for us to never ever expose our investors to the risk of permanent capital loss.
Just in terms of some of those holdings, the number one holding at the moment is Carrefour, which I understand is a French retailer. Just give us some of the reasons why you've made that the top pick in this particular fund, and what has led to this company being mispriced or offering such value that it's being ignored by other investors.
Well, Carrefour is a great example of where the value philosophy really points to great investment opportunities which may be overlooked by other investors in the market. So as you rightly pointed out, Carrefour is a predominantly European retailer. It's actually the second biggest retailer in the world after Walmart. And most of its exposure is in areas like France. They do have other businesses globally, but predominantly European and French retail exposure. Now, we started investing in this business approximately a year ago at the beginning of 2012. And at the time, you can imagine there was a lot of negative news about the European economy as a whole. And anyone with sort of a top-down process which looks for investment ideas, starting with sort of economic growth projections and that sort of thing, would have immediately discounted that region and looked elsewhere, perhaps at Africa or China or the likes. Now, when there's negative news in a region, that really is where we go hunting for high-quality businesses, because the chances are that that negative news has caused some companies which may be less affected or are so underpriced that they present a fantastic opportunity to be tarred by the same brush as all the other businesses in the area. And Carrefour was a great example of that. It's actually up significantly over the last year. And just to give you a gauge of sentiment, midway through last year, on the cover of Time magazine was the decline and fall of Europe. Since then, Carrefour is up sort of in the region of about 70% in US dollar terms. When we bought it, the price was so low that it was trading below its property book alone.
Let's chat about BP also in your portfolio. We spoke about it extensively last year. I see there's been a shift in terms of your February 2012 holding and your February 2013 holding. It's gone from some 3.4% to 2.6% of your portfolio. How has it done for you? Obviously, you've taken some money from the performance on BP.
Yes, that stock has been quite volatile. There's a lot of uncertainty there. They had some issues with their Russian associates sort of towards the beginning of last year, and you see quite a sort of fall off in the price there. There's a lot of uncertainty with regards to the cost of their major oil spill still, but that uncertainty still presents an opportunity. So we still hold a nice position in BP, and we still think that there's value in that stock.
Have you traded the volatility though, Linda, in terms of the reduction of your portfolio there? Or the reduction
Not
rather of your
specifically
holding?
We do, if prices move considerably below our fair value and present a far greater margin of safety, we certainly increase our position. It really depends on the merits of that investment thesis, our calculation of the fair value, because remember, with a high quality business, often your fair value is actually increasing over time. So we obviously look at that as well, and it's a function of all those things together. But yes, volatility often does present a wonderful opportunity to increase your exposure.
You are still backing that BP story irrespective of the uncertainty that you've highlighted?
Absolutely. The uncertainty has caused the price to be cheap. So what you tend to find is where there's a lot of uncertainty, investors tend to steer away because they're worried about the short-term impact on prices. As value investors, we're looking at the long-term investment outcome, and BP, along with many other businesses, such as Carrefour, such as the Greek stocks that we invested in a year ago, which have done phenomenally well since then, were cheap and are cheap precisely because of uncertainty, which other investors shy away from.
Linda, I just wanted to get to a stock that I think everyone knows, and that's Berkshire Hathaway. And I know that Warren Buffett and Charlie Munger do a very good job of telling investors every year exactly whether they think the stock is mispriced or not. In fact, I think he goes into some detail in his letter to shareholders around what he calculates the intrinsic value of Berkshire to be. Yet it's in your portfolio, and it's stayed pretty constant. It's gone the size has increased slightly to 3.1% of the portfolio. How do you reconcile the efforts of the chairman trying to get the investors to understand the fair value and buying into a cheap stock?
Well, Berkshire Hathaway is an example of something where essentially the businesses that they're investing in, they obviously have a similar philosophy to ours. The one benefit that they have is they don't need to worry too much about short-term issues because it's permanent capital. Investors can't move in and out. They can just sell their share to somebody else. So that capital is permanent. That's a wonderful condition to identify value over the long term. And as a result, they tend to invest in businesses which are substantially growing their intrinsic value over time. So over the past year, that intrinsic value has grown, and we simply do an analysis of the underlying assets and look at the price compared to that and make an assessment ourselves. What we don't do is price in any premium for the management expertise of the likes of Buffett and Munger. So we're literally looking at the assets alone, and their expertise is really just a cherry on top.
Sun International, let's move back to one of the local stocks in your portfolio. You're still holding out on this one, Linda. What are the prospects to unlock that value?
Well, Sun International has actually done very well over the last year. We have held it actually for several years, though. So we've been waiting for this stock to reprice for quite some time. And we're starting to see some really promising signs coming out of the industry it's in. Obviously, Sun International is exposed to both gaming and the hotel industry. And you've seen the cycle there. It's a very cyclical business. very much out of favor because it's been at a very low point in its cycle, and the market tends to extrapolate that into the future. But recently you've seen hotel occupancies up from their lows, you've seen gaming revenues up, so that stock has actually done quite nicely for us over the last year.
Do you believe it's going to push higher? Is it going to push higher from current levels?
It's certainly still well below our fair value. It's certainly still well below our fair value for the stock.
Quite interesting that pick, Linda, as you pointed out, it's a cyclical company as I understand it, and yet you say you've held it for quite a few years. When is it time to exit a stock in the RECM portfolio?
Well, where it's at in the cycle is one component of the analysis. So we prefer businesses which are trading at a discount to fair value and are at cyclical lows, because the market does tend to extrapolate in perpetuity the current part of the cycle they're in right now. But it's just one of the equations. So the things we look at is the quality of the business, where in the cycle is it, and of course that discount to fair value plays a huge part in, how much of that particular stock we'll hold.